The economic waters are getting choppy. We're facing a perfect storm of high household debt, overvalued stocks, and the looming threat of a market downturn. It's a time for caution, for careful navigation, and for making sure your financial ship is ready to weather the storm. Don't be caught off guard. It's crucial to understand the risks we face and to equip ourselves with the knowledge and strategies to protect our financial well-being. This isn't about panicking. It's about being prepared. We need to look at the economic indicators, understand the potential pitfalls, and make informed decisions about our investments. This is about taking control of our financial future and making sure we're not swept away by the currents of market turbulence. We're going to explore the factors contributing to this volatile financial climate. We'll delve into the risks associated with high household debt and the potential consequences of a market correction. We'll also examine the importance of prudent investment strategies, like value investing and focusing on low-risk assets. This is a time for vigilance, for informed decision-making, and for securing our financial future. Together, we'll navigate these rough seas and emerge stronger on the other side. Don't be afraid to ask questions, to seek guidance, and to take the necessary steps to protect your financial well-being.
The Federal Reserve plays a critical role in shaping the economic landscape. Its monetary policy decisions can have a profound impact on the markets. In recent years, the Fed has maintained historically low interest rates and pumped trillions of dollars into the economy. While these measures were intended to stimulate growth, they have also contributed to asset bubbles and financial instability. Now, facing rising inflation, the Fed is starting to tighten monetary policy. This means raising interest rates and reducing its balance sheet. These moves are necessary to combat inflation, but they also carry the risk of slowing economic growth and potentially triggering a recession. This delicate balancing act is fraught with uncertainty. The Fed's actions can exacerbate market downturns. When the Fed raises interest rates, it becomes more expensive for companies to borrow money. This can stifle investment and slow economic activity. At the same time, higher interest rates make bonds more attractive relative to stocks, which can lead to a shift in investor sentiment away from equities. In these turbulent times, it's more important than ever to adopt a prudent investment strategy. Value investing offers a safe harbor in the storm. This approach focuses on identifying undervalued companies with strong fundamentals and a margin of safety. Value investors are patient and disciplined, waiting for opportunities to buy stocks at a discount to their intrinsic worth. Value investing is a long-term strategy. It's not about chasing quick profits or getting caught up in market hype. It's about investing in quality companies that are built to last. Value investors understand that the market can be irrational in the short term, but over the long term, value will be recognized. This approach has proven its merit over decades. Value investors like Warren Buffett have consistently outperformed the market by sticking to their principles and avoiding speculative excess. In a volatile market, value investing provides a beacon of stability and a path to long-term financial success.
When the economic winds howl, it's essential to have a portion of your portfolio in low-risk assets. These assets provide stability and act as a buffer against market volatility. They may not offer the same potential for high returns as stocks, but they can help preserve your capital and provide peace of mind during turbulent times. Bonds are a classic example of a low-risk asset. They represent loans to governments or corporations and typically offer a fixed rate of return. While bond prices can fluctuate, they tend to be less volatile than stocks. High-quality bonds, such as US Treasuries, are considered among the safest investments in the world. Cash is another low-risk asset. It doesn't offer any return, but it provides liquidity and flexibility. Holding a portion of your portfolio in cash allows you to take advantage of opportunities that may arise during a market downturn. It also provides a safety net to cover unexpected expenses.
In times of economic uncertainty, investors often turn to precious metals as a safe haven. Gold, silver, and platinum have historically held their value during periods of inflation and market turmoil. They are tangible assets that are not subject to the same risks as stocks and bonds. Gold in particular has long been viewed as a store of value. It has been used as a form of currency for centuries and is seen as a hedge against inflation. When the value of paper money declines, gold tends to hold its value or even appreciate. This makes it an attractive investment during times of economic instability. Investing in precious metals can provide diversification to your portfolio. They tend to move independently of stocks and bonds, which can help reduce overall portfolio volatility. However, it's important to remember that precious metal prices can fluctuate, and there is no guarantee of returns.
While market downturns can be unsettling, they also present opportunities. This is a time when strong companies with solid fundamentals can shine. Look for companies with a proven track record of profitability, a strong balance sheet, and a competitive advantage. These companies are built to weather economic storms and emerge stronger on the other side. Investing in quality companies is not about speculation. It's about partnering with businesses that are well managed, financially sound, and positioned for long-term growth. These companies may experience short-term setbacks during a downturn, but their underlying strength will allow them to recover and thrive. This is the time to focus on the fundamentals. Look beyond the short-term noise and focus on the long-term prospects of the companies you invest in. Seek out companies with a history of innovation, a commitment to customer satisfaction, and a strong management team.
We're navigating treacherous economic waters. High household debt, speculative excess, and the looming threat of a market downturn are creating a perfect storm. But we can weather this storm by staying informed, making prudent decisions, and focusing on long-term financial security. Value investing, low-risk assets, and precious metals can provide stability and a measure of protection during turbulent times. Remember, investing is not about timing the market. It's about time in the market. By staying disciplined and focused on our long-term goals, we can navigate these challenges and emerge stronger on the other side. This is a time for caution, but not a time for fear. By understanding the risks, making informed decisions, and seeking guidance when needed, we can chart a course through these turbulent waters and reach our financial destination. Let's proceed with caution, vigilance, and a steadfast commitment to our financial well-being.